If you want to know if the American consumer is, like, panicking right now, you really shouldn't look at the stock market.
Right, because the stock market is just an abstraction.
Exactly. I mean, don't look at the bond yield curve, and definitely don't look at federal interest rate charts that require uh, a PhD in macroeconomics just to decipher.
Yeah, those won't give you the real story on the ground.
No, they won't. If
Now,
you want a real-time, completely unvarnished pulse check on the exact financial reality of the American household, you need to look at aisle 4 of your local hardware store.
that is so true. It's the perfect metric.
Right. You look at what people are buying for their homes, what they're choosing to repair, and crucially, what big projects they are completely avoiding.
It truly is the ultimate leading indicator. Because a home isn't just, an asset on a spreadsheet.
Mm-hmm.
For most people, it's the physical space where consumer confidence violently collides with economic reality. When you track how people spend on their homes, you are looking directly at how they feel about their financial future.
Yeah, if they are expanding, they are optimistic. But if they're just, like, patching the roof, they are bracing for impact.
Exactly. Bracing for impact is a great way to put it.
Which brings us to the mission of today's deep dive. We are looking under the hood of a massive quarter from Lowe's companies. And I'm not just talking about a dry financial update.
No, there's a lot more to it this time.
We are talking about dissecting a $23 billion quarter to see how a legacy physical retailer, a place you go to buy 2x4s, mulch, and wash machines, is using cutting-edge artificial intelligence and, honestly, bags of dog food
Bags of dog food, yeah.
to survive what is arguably the worst housing market since the 2008 financial crisis.
And they are doing all of this while simultaneously attempting to capture a massive $250 billion new market.
A market they historically had, almost zero footprint in?
Practically zero, yeah. What we are examining today is a masterclass in a concept business leaders call controlling the controllables.
Controlling the controllables, I like that.
It's an exploration of how a giant corporate ship steers when the macroeconomic winds are actively trying to blow it backward.
Okay, let's unpack this because we really need to start with the sheer scale of those headwinds. The top-line numbers I saw were incredibly green for an environment that is supposedly so toxic right now.
They really were.
I know they pulled in something like $23 billion, but how does that actually translate to growth when nobody is, buying houses?
Well, the exact figure was $23.1 billion in sales for the first quarter.
Wow.
Yeah, which is a 10.3% increase. Furthermore, their comparable sales, what the retail industry calls comps, measuring sales in stores open for at least a year, were actually up 0.6%.
Okay, 0.6% might sound tiny to some people.
It does sound small, but this marks their fourth consecutive quarter of positive comps in a highly contracted market.
4 quarters in a row, that's huge.
Exactly. They also delivered an adjusted diluted earnings per share of $3.03, which is up 3.8%.
Okay, but how?
Well, to understand how they achieved that, you have to put yourself in the shoes of the American homeowner right now. You have to understand the macroeconomic trap they're caught in.
I imagine it has absolutely everything to do with mortgage rates.
It's entirely mortgage rates. The executives at Lowe's explicitly highlighted two phenomena driving consumer behavior right now: the lock-in effect and the K-shaped economy.
Okay, let's break down that lock-in effect first, because it is basically freezing the housing market, right?
Totally freezing it. Due to elevated interest rates over the last few years, a massive portion of homeowners have mortgages locked in at historical lows. We are talking 3, maybe 4%.
Right, and current rates are hovering significantly higher than that.
Much higher. So let's play this out. Imagine you bought a starter home in 2019.
Okay, I'm with you.
You've got a great 3% rate. But now it's 2026, you've had 2 kids, and you are bursting at the seams. You desperately want a bigger house.
But when you look at the math, trading a 3% mortgage for a 7 or 8% mortgage on a more expensive house, I mean, your monthly payment doesn't just go up a little, it practically doubles.
It's financial suicide.
Yeah, nobody is going to do that.
And that is the exact mathematical wall millions of families are hitting right now. Historically, housing turnover, people moving in and out of houses, is the massive engine that drives home improvement spending.
Oh, sure. When you buy a new house, you want to remodel the kitchen, you paint the living room, you update the bathrooms to make the space yours.
Right. And conversely, when you sell a house, you do a flurry of repairs to get it ready for an inspection.
So with turnover at historically low levels, that entire engine of discretionary, big-ticket DIY spending has practically ground to a halt.
Yes, the executives noted that DIY demand is severely under pressure, specifically in those optional expensive projects.
It's like the housing market is a giant game of musical chairs, but the music stopped and everyone just like glued themselves to their seats.
That's a perfect analogy.
Nobody is getting up. But wait, if nobody is moving and nobody is doing those big fun renovations, how on earth is Lowe's growing its comparable sales? The math just doesn't seem to add up there.
The math adds up when you look at the underlying breakdown of what Lowe's actually sells. It is their ultimate shield in this environment.
Okay, what's the breakdown?
Two-thirds of Lowe's business is comprised of repair, maintenance, and replacement. Only one-third is discretionary.
Oh, I see. So if you want a new cedar deck, but money is tight because of inflation, you put it off.
Exactly. That's the discretionary one-third. But if your water heater explodes at 2 in the morning and floods your basement,
You are buying a water heater today.
you are buying it today. You don't care what the Federal Reserve is doing with interest rates. You are swiping your credit card.
Yeah, that non-discretionary spending makes up the other two-thirds. Okay, that makes sense.
Oh.
The sink still leaks even if the mortgage rate is high. But you still have to offset the massive loss from that one-third of discretionary spending. I mean, I'm looking at the regional data they provided, and 11 out of their 15 regions delivered positive comp sales growth.
Right.
And the average amount a customer spent at the register, the average ticket, was $107.59, which is up 1.5%. They are squeezing more blood out of the stone. Who is spending this money?
This is where we see the impact of that K-shaped economy I mentioned.
Ah, right. Let's get into that. What does that mean exactly?
So in a K-shaped recovery, different segments of the population experience vastly different financial realities. The upper arm of the K represents higher income consumers who have robust savings, perhaps strong stock portfolios.
And they're still spending.
Yes, they are still spending, particularly on innovation and modernization for their homes.
And the lower arm?
The lower arm represents lower to middle income consumers who are facing serious macro pressures, inflation, credit card debt, and they're pulling back sharply.
So the people who have money are still spending it, and the people who don't have just slammed their wallet shut.
Precisely. But Lowe's recognized that relying entirely on the upper arm of the K-shaped DIY market isn't a sustainable growth strategy.
No, it wouldn't be.
So to truly offset the weakness in the broader DIY segment, they executed a massive strategic pivot to aggressively target a completely different type of customer, the pro.
Okay, when we say the pro, we were talking about contractors, right? Plumbers, electricians, the folks driving the white vans with the ladder racks.
Yes, specifically the small to medium pro. While the average DIR is holding off on building their own patio, these independent contractors are still incredibly busy.
Because people are still doing repairs.
Exactly. People might not be doing massive whole home renovations, but they are absolutely hiring pros for necessary repairs, essential maintenance, and smaller piecemeal upgrades.
So Lowe's essentially has to run two entirely different businesses under one roof.
That's exactly what they're doing. They have one strategy for the stressed DIYer and a completely different, highly aggressive strategy for the pro.
Okay, let's unpack the DIY side first, because I noticed something fascinating in their strategy here. They know the average homeowner is stressed and putting off big projects.
Right.
So instead of pushing them to buy a, $5,000 kitchen island, Lowe's is trying to build incredibly sticky, low-level loyalty.
Yes. They want to ensure that when a DIR does spend $50, they spend it at Lowe's.
Right. For example, they rolled out free same-day delivery on purchases over $25 for their MyLowe's Rewards members.
It's a massive convenience play. It's designed to intercept the customer before they even think about driving to a competitor.
Yeah, if you need a bag of potting soil and some gardening gloves on a Saturday morning and you are in the loyalty program, Lowe's will just eat the delivery cost to keep you in their ecosystem.
Exactly. But the delivery thing is kind of table stakes in retail these days.
Totally. But the initiative that made me do a double take is something they are calling Home Care Plus C.
Oh, yes.
I read the description for this, and I genuinely thought I was reading a pitch for a Silicon Valley tech startup, not a hardware store.
Home Care Plus is, without a doubt, one of the most fascinating developments in modern retail. It is a first-of-its-kind subscription service for routine home maintenance.
Just for the rewards members, right?
Yes. Designed exclusively for their MyLowe's Rewards members. They are utilizing trained, local Red Vest associates to physically go to a customer's home and help them stay on top of their routine maintenance to-do list.
This blew my mind. They are fundamentally treating homeownership like a software as a service subscription.
They really are.
You pay a recurring fee, and a Lowe's employee comes out to your house to change your hard-to-reach HVAC filters, check the batteries in your smoke detectors, clean out your dryer vent, flush your water heater, whatever is on that preventative maintenance schedule.
It is a pure ecosystem lock-in strategy. I mean, think about it. Most homeowners do not know how to properly maintain their homes,
I definitely don't.
right? Which leads to catastrophic failures down the road. By offering this service, Lowe's positions itself not just as a retailer, but as the operating system for your house.
The operating system for your house.
Yeah.
Wow.
If a Lowe's associate is already in your basement checking your water heater, and they notice you need a new sump pump, where do you think you're going to buy that sump pump?
Exactly. You aren't going to shop around. You are going to tell the associate to just add it to the bill. It's brilliant.
It really is.
But while they are essentially coddling the DIYer with subscriptions and free delivery, they are taking a remarkably different approach with the pro customer.
A very different approach.
The pro segment delivered another quarter of solid growth, and it seems like their entire pitch to the contractor is based on one specific metric, and that's time.
Because for a contractor, time is their most constrained and valuable asset. Lowe's understands this perfectly.
What are they doing to save them time?
They have expanded their Pro Extended Aisle. This gives contractors access to a massive digital inventory of job lot quantities.
Job lot quantities, meaning pallets of materials, not just individual items.
Exactly. And they do this without Lowe's having to physically stock all of it in the back room of every single store. They're streamlining the procurement process so the pro spends less time shopping and more time on the job site billing hours.
I get the inventory management part. That makes total sense to me. But I have to push back on their next move because it seems completely outside the lane of a big box retailer.
Oh, you mean the foundation investment?
Yeah. The CEO, Marvin Ellison, highlighted a $250 million investment by the Lowe's Foundation to train 250,000 skilled tradespeople over the next few years.
Yes, it's a massive initiative.
Now, I'm all for corporate philanthropy, but are they seriously trying to become a vocational school? Why is a company that sells pipes and wires spending $250 million to teach teenagers how to solder? It feels like mission creep.
I completely see why it looks like mission creep on the surface. But if you look at the structural bottlenecks in the home improvement industry, it is actually a masterstroke of strategic self-preservation.
Okay, explain that to me.
This is not just a charity write-off. When Lowe's surveys their core pro customers, the contractors who spend tens of thousands of dollars a month, those pros report that their backlogs of work are highly stable.
So there is plenty of consumer demand for repairs and upgrades.
Plenty of demand.
Okay, so if demand is high, what's stopping them from buying more material?
Labor. The number one constraint on a contractor's growth right now is the sheer inability to find trained, reliable labor to fill out their crews.
Oh, interesting.
We are facing a massive demographic cliff in the skilled trades right now. Older tradespeople are retiring, and for decades, high schools push students toward four-year degrees while defunding vocational shop classes.
Ah, I see the mechanism now. Imagine you are a successful local plumber. Your phone is ringing off the hook. But because you can't find an apprentice, you can only take on 2 bathroom remodels a week instead of 4.
Precisely. And if that plumber only takes on 2 jobs, he is only buying 2 bathtubs, 2 vanities, and 2 sets of fixtures from Lowe's.
Wow. So by investing $250 million to physically seed the next generation of skilled workers, Lowe's is literally manufacturing their own future demand.
It is the ultimate vertical integration of the customer base. By solving the contractor's biggest pain point, the labor shortage Lowe's ensures that the contractor has the capacity to keep buying massive quantities of material. They are building the infrastructure of the market itself.
That is wild. They are practically printing their own future customers.
They really are.
But here is the friction point I keep coming back to. Handling all these wildly different strategies simultaneously requires a staggering amount of overhead.
It certainly does.
You are coordinating 2-hour mulch deliveries for DIYers. You are dispatching Red Vest associates to clean dryer vents. You are managing complex job lot logistics for contractors. And you are overseeing a massive vocational grant program. The logistical weight of that is immense.
It's a huge operational burden.
Yet, when I looked at their financials, their SG&A, their selling, general, and administrative expenses, which is basically the total cost of running the corporate machine, actually improved.
Yes, it did.
It leveraged by 17 basis points, dropping down to 19.2% of their total sales. How are they doing exponentially more complex work with proportionally less money?
The answer to that efficiency paradox is found on aisle 4, but it's not a product on a shelf. It exists in the cloud.
Okay, now I'm intrigued.
The primary mechanism driving this leverage is their surprisingly advanced enterprise-wide integration of artificial intelligence.
AI, of course.
And I want to be clear here, they are not just dabbling in AI to write marketing emails. They are weaving it into the core operational fabric of how they sell, how they stock, and how their employees function.
Let's dive deep into this, because when most people hear retail AI, they immediately picture those infuriating little chat bubbles that pop up on a website.
Oh, everyone hates those.
Right. You ask it a question it doesn't understand, and it just traps you in an endless loop until you scream for a human operator.
Yeah, that's the old model.
But the numbers Lowe's reported for their AI tools are, frankly, unbelievable. They have a virtual assistant called Milo for online shoppers, and it is currently handling over 1 million customer inquiries every single month.
That volume is huge.
But here is the metric that stopped me in my tracks. The conversion rate, meaning the percentage of people who actually follow through and buy something for customers who interact with Milo, is triple that of customers who do not use the tool.
Triple. Yes.
Tripling a conversion rate in e-commerce is unheard of. It's the holy grail.
Yeah.
How is this AI fundamentally different from the bots we all hate?
It is different because of the underlying architecture. A traditional retail chatbot utilizes a rigid decision tree.
Like an if-then statement.
Exactly. It operates on simple logic. If the user types hammer, output a link to the hammer department. If the user types a complex sentence, the bot fails because it isn't on the tree.
Right.
What Lowe's has built with Milo is based on what the CEO specifically termed agentic commerce.
Agentic commerce, meaning the AI acts as an independent agent.
Exactly. Milo is built on a massive open AI platform and is given autonomy and a goal rather than a script. It doesn't just answer questions, it actively guides complex purchasing decisions.
Give me an example of how that actually works.
Let's walk through a scenario. Imagine you want to build a raised garden bed, but you have zero carpentry experience.
Okay.
You go to Lowe's website and tell Milo, I want to build a 4x8-foot raised garden bed for vegetables, and my budget is $200.
A normal search bar would just show me 100 different planks of wood and leave me to figure it out.
Right. But Milo, functioning as an agent, actively goes to work. Yeah. It understands that you are growing vegetables, so it instantly filters out chemically treated lumber that could leach toxins into the soil.
Oh, wow.
It calculates the exact linear footage of untreated cedar you need. It cross-references the weight of the soil to recommend the correct shear strength for the exterior wood screws.
That is incredibly specific.
It is. It calculates the cubic yards of organic raised bed soil required to fill a 4x8 space. It checks the real-time inventory of your local store, packages all those items together, ensures the total is under $200, and presents you with a single button to add to cart.
That is amazing. It is entirely removing the cognitive load and the fear of making a mistake. It acts as a consultative partner.
Exactly. No wonder the conversion rate triples. It is holding the customer's hand through the most intimidating part of the DIY process.
It eliminates the friction of doubt. But what is perhaps more impressive is that they didn't isolate this technology to our website.
No, they didn't.
They brought this exact agentic capability into the physical stores with an internal tool called Milo Companion. They reported that this tool just passed a milestone of 5 million associate questions since it launched.
5 million? That's massive adoption.
And they also recently upgraded it to include voice detection and real-time Spanish language capabilities. So, if Milo Online is a guide for the customer sitting on their couch, what is Milo Companion doing for the associate wearing the red vest in the aisle? Is this just a fancy way for the company to phase out expert floor workers and replace them with cheap labor holding tablets?
It's actually the exact opposite. It is an equalizer and an incredible accelerator of competence.
How so?
Consider the reality of home improvement retail. It is a highly technical field. When the spring rush hits, Lowe's hires thousands of seasonal associates.
Right.
A new 19-year-old hire cannot possibly memorize local municipal plumbing codes, electrical load specifications, and the grading standards of different types of lumber in a one-week training seminar.
No, of course not.
Historically, if a customer asked a complex question, that new associate would freeze, apologize, and wander the store for 20 minutes trying to hunt down the one veteran employee who knew the answer. It wasted everyone's time and frustrated the customer.
Oh man, I've been that frustrated customer. So instead of wandering around, the new associate just pulls out their device. It's like having Jarvis from Iron Man wearing a red vest standing right next to you.
That's a great way to think of it.
You ask it, what is the code requirement for a GFCI outlet installed in a wet location in this specific county? And the AI instantly parses the code book and gives the associate the answer.
Precisely. In fact, the CEO shared a highly illustrative anecdote on the earnings call. He was visiting a store and met an associate who had been on the job for less than a month.
Okay.
Using the Milo Companion tool, this brand new employee was able to give the CEO a flawless, comprehensive demonstration of how to navigate incredibly complex home improvement tasks.
That's incredible.
By accelerating the competence of the associate, you instantly remove the friction for the customer standing in the aisle. The tangible result of this. Management noted that the deployment of this tool has directly contributed to a 200 basis point increase in their customer satisfaction scores.
200 basis points. That is a massive jump in retail satisfaction.
It really was.
And they are building these AI tools specifically to target the pro customer as well. They mentioned something called the pro materials list.
Yes.
Now, I have friends who are contractors, and they are notorious for their lack of organization. They will literally hand an associate a messy list scribbled on a napkin or a blurry, grease-stained photo of a whiteboard or some weird, unformatted PDF of the materials they need for a job.
And historically, that messy napkin was an administrative nightmare.
I can imagine.
A Lowe's associate would have to take that napkin, sit down at a terminal, try to decipher the handwriting, manually search the inventory system for every single SKU, check availability, and type it all in to generate a quote. That process could take days, during which time the contractor might just go to a competitor.
But now they take that napkin, snap a photo of it, and run it through this computer vision AI tool. The AI reads the handwriting, understands the context. It knows that 2x4x8 means a 2x4 piece of lumber, 8 feet long, cross-references the store's inventory, and converts it into an actionable priced quote in a matter of minutes.
It fundamentally transforms an administrative bottleneck into instant revenue. We established earlier that time is money for the pro.
Right.
If Lowe's can process a complex job, quote, in 5 minutes, while the local lumberyard takes 2 days, Lowe's wins the business every single time, and the efficiency gains don't stop at the store level.
Well, where else are they using it?
They noted that their internal corporate tech teams are using AI for code review and software development, and they are seeing double-digit productivity gains. They are deploying AI across the entire spectrum. It changes how they sell, how the customer shops, and how their internal teams work.
Okay, so their digital infrastructure is light years ahead of where I thought it was. The strategy is definitely dialed in. But let's bring this back down to earth. At the end of the day, all the AI in the world can't physically hand a customer a bag of mulch. Retail ultimately comes down to moving physical boxes in physical stores and executing under pressure.
That's the truth.
And for the home improvement sector, the first quarter encompasses their Super Bowl, the spring season. This year, their SpringFest promotional event had to do an immense amount of heavy lifting to save the quarter.
It certainly did, because the quarter started off quite rough. February saw severe, protracted winter storms across much of the United States.
Yeah, the weather was awful.
In the retail calendar, weather is a massive, uncontrollable variable. Those storms created a 30 basis point drag on the entire quarter's performance right out of the gate. In fact, comparable sales in February were actually down 1.4%.
Ouch. But then the weather finally broke, the sun came out, and their physical execution kicked into high gear. The momentum swung violently.
It did.
March comps accelerated to a positive 2.1%, and April held steady at a positive 0.5%. Ultimately, during the SpringFest event, 9 of their 13 product categories saw positive comparable sales.
That's a huge recovery.
But to achieve that level of operational efficiency, they actually had to restructure how they merchandise the entire store. They reduced their internal merchandising divisions from 14 down to 13.
Right.
And specifically, they took power tools, things like drills and circular saws, and outdoor power equipment, things like electric leaf blowers and lawnmowers, and combine them into one single management division.
Now, on the surface, corporate restructuring sounds like dry administrative trivia.
Mm.
But if you look at the mechanism behind this change, it reveals a profound understanding of modern consumer psychology and ecosystem lock-in.
Explain that mechanism to me. Why does moving a weed whacker into the same division as a power drill move the needle for a multi-billion-dollar company?
All comes down to the battery.
The battery.
Yes. Historically, power tools and outdoor equipment were distinct categories with different suppliers and different use cases. But over the last decade, lithium-ion battery technology has revolutionized both spaces.
Oh, okay.
The modern consumer is incredibly frustrated by having 5 different incompatible battery chargers cluttering up their garage wall. They want one unified battery platform.
I see exactly where this is going. If I spend $150 on a DeWalt cordless drill, I now own a DeWalt 20-volt battery.
Exactly.
When summer rolls around and I need a string trimmer for my yard, I don't want to buy a whole new brand with a different battery and a different charger.
Oh.
I want the DeWalt string trimmer so I can just swap the battery I already own.
Precisely. The battery is the anchor. By aligning the merchants who buy the power tools with the merchants who buy the outdoor equipment into one unified division, Lowe's can better coordinate with their massive supplier partners.
To make sure they have all the compatible tools.
Right, to manage those battery platforms cohesively across the entire store.
Yeah.
Once a customer invests in a specific 20-volt or 40-volt battery system, their switching costs become incredibly high. They are highly unlikely to switch brands.
It's pure lock-in.
If Lowe's can perfectly merchandise that battery platform and ensure they have every compatible tool in stock, they create an ecosystem that drives inevitable repeat purchases. They effectively own that customer's tool purchases for a decade.
It is exactly the Apple ecosystem model where your iPhone locks you into buying the MacBook and the Apple Watch, but applied to power tools. That is brilliant.
It really is.
And speaking of changing what they put on their shelves to maximize revenue, they're rolling out some product categories that you wouldn't traditionally associate with a lumberyard.
They are expanding quite a bit.
They're heavily expanding their workwear section, specifically partnering with premium national brands like Carhartt, and they're bringing pet products, including both national brands and their own private labels, to all their stores nationwide by the end of the year.
Yes, the TED expansion is interesting.
I have to be honest, when I saw the dog food announcement, it felt a little desperate. Are they just throwing spaghetti at the wall to generate foot traffic because lumber isn't selling?
It is a fair question, but it isn't desperation. It is a highly calculated play based on a retail metric known as space productivity.
Space productivity, what is that?
It measures exactly how much revenue and profit you can generate per square foot of retail space. A Lowe store is massive, but items like dimensional lumber, drywall, and insulation take up an exorbitant amount of physical space while yielding relatively low profit margins.
Right, a pallet of 2x4s is huge, but it might only generate a few $100s in profit.
Precisely. Pet food and premium workwear, on the other hand, require a very small physical footprint, yield higher margins, and crucially, they represent high-frequency purchases.
Oh, high frequency.
Think about the life cycle of home improvement items. You might buy a refrigerator once every 10 or 12 years. You might build a deck once in a lifetime. But if you have a dog, you're buying a large bag of dog food every 3 to 4 weeks, like clockwork.
So, by stocking the dog food, they are artificially increasing my frequency of visits. I might not need a hammer this month, but if I know Lowe's has the specific brand of dog food I need, it gives me a reason to walk through their doors on a random Tuesday.
Exactly.
And while I'm walking past aisle 4 to get the dog food, I might remember that I need air filters, or I might impulsively buy a new drill bit set. They are increasing the basket size by using a high-frequency anchor.
It leverages their existing physical footprint to capture recurring revenue that would otherwise go to a grocery store or a big box competitor.
That's smart.
But while we're discussing the psychology of the retail purchase, we have to look at the appliances segment. Despite the massive pullback in discretionary DIY spending, their appliances segment was actually positive for the quarter.
Really? With people not buying houses?
Yes, and management shared a statistic regarding appliances that perfectly illustrates the resilience of their business model. 70% of all major appliance purchases are what they classify as duress occasions.
A duress occasion, meaning nobody wakes up on a beautiful Tuesday morning, stretches, and thinks, you know what would be a really thrilling use of my disposable income today? Dropping $2.5 grand on a new washing machine just for the fun of it.
Precisely. A duress purchase is the definition of non-discretionary spending. It means the old appliances catastrophically failed at the worst possible time.
Yeah, like the compressor on the refrigerator died and a month's worth of groceries is rapidly spoiling. Or the washing machine drum cracked and is currently flooding the laundry room floor.
Exactly. It is an urgent, highly stressful, panic-driven purchase. The customer does not have the luxury of waiting.
And this is where their logistical infrastructure becomes an absolute weapon, because when my fridge dies, I am not going online, ordering from a digital-only retailer, and waiting 4 to 6 business days for a freight delivery while my milk curdles.
You can't wait that long. The executives on the call proudly noted that Lowe's is currently the only retailer in the country that has the logistical capability to deliver and install major appliances the very next day in virtually every single ZIP code in the United States.
That is a staggering logistical footprint.
It is massive.
They have built an omni-channel experience perfectly designed to capture the panic buyer. Your fridge dies at 6 p.m. You frantically research models on your phone using their Milo AI. You drive down to the local store at 8 p.m. to physically open the doors and touch the buttons with a red vest associate.
And you swipe your card.
Right. And the new fridge is humming in your kitchen by 10 a.m. the next morning. They win the sale entirely on the speed of their execution.
It is the ultimate fusion of digital discovery and physical infrastructure.
Yeah.
But, there is a fundamental ceiling to this strategy.
What's the ceiling?
Well, while Lowe's is optimizing every square inch of their existing business, from agentic AI to high-frequency dog food to next-day appliance delivery, there's a hard limit to how much revenue you can extract from the existing frozen housing market.
Yeah, that makes sense.
If nobody is moving and you've already sold everyone a new fridge, where does the new growth come from? To truly expand their horizon, Lowe's had to look outside their traditional four walls. When you can't squeeze another dollar out of a homeowner repairing their current house, you have to go after the people building the new houses.
And that transition brings us to what might be the most aggressive, high-stakes move they made all quarter. We established that Lowe's is a titan in the existing home market, the remodels, the roof repairs, the appliance replacements.
Right.
But historically, they had almost zero footprint in the market for new residential home construction or large-scale multifamily commercial projects. They simply didn't have the supply chain or the relationships with the massive national home builders.
No, they really didn't.
So to get a piece of that massive pie, they didn't try to build a division from scratch. They opened their corporate wallet and bought their way into the market. They made 2 major acquisitions: Foundation Building Materials, or FBM, and Artisan Design Group, ADG.
These are highly strategic, deeply synergistic acquisitions. Let's examine the mechanics of what these companies actually do. ADG Artisan Design Group is heavily focused on the distribution and installation of interior construction products, specifically for new home and multifamily construction. They're the ones dealing directly with the home builders to supply the flooring, the cabinets, the interior finishes at a massive scale. FBM Foundation Building Materials is a massive distributor serving both commercial and residential builders with heavy construction products.
Heavy construction? Like what?
We are talking about the foundational materials. Tens of thousands of tons of drywall, structural steel framing, commercial-grade insulation, and acoustical ceilings. FBM is currently winning massive, multi-year contracts to supply materials for data centers, municipal stadiums, and large hospital complexes.
Think about this in terms of playing a game of Monopoly. For decades, Lowe's has been playing by a rule that says you can only build houses on properties that already have existing structures on them.
Right.
You can remodel Marvin Gardens, but you can never buy an empty lot. With the acquisitions of FBM and ADG, Lowe's just bought the right to build the monopoly board itself. They are getting in on the ground floor of new construction long before a homeowner ever turns the key.
It's a massive shift in their business model.
And the financial projections they are looking at for this new market are staggering. Management estimates that the total addressable market, the TAM, for this commercial and new build space is a jaw-dropping $250 billion.
$250 billion.
Yes. Furthermore, demographic data projects that 12 million new homes will be needed by 2033 just to meet basic population demand and overcome the current housing deficit.
It is a massive demographic and structural tailwind that they are positioning themselves to ride. However, integrating massive companies of this scale into a legacy corporate structure is not a clean process.
No, I imagine it's pretty messy.
It has immediate, messy financial consequences. And this is where we have to look very closely at the Form 8K they filed with the SEC, because the numbers look quite alarming at first glance.
What were the numbers?
The integration of FBM and ADG actually triggered a $96 million pre-tax charge against their earnings in the first quarter. Management noted this was primarily due to intangible asset amortization related to the acquisitions.
Wow, 96 million.
Furthermore, absorbing these companies was the primary driver of a 70 basis point decline in Lowe's overall gross margin, dragging it down to 32.7%.
Okay, let's pause and unpack that. If I'm a retail investor and I read an SEC filing that says the company just took a $96 million hit and their gross margin plummeted by nearly a full percent in a single quarter, I might start hyperventilating and hitting the sell button.
Many would, yeah.
But Wall Street didn't freak out. The stock didn't crater on this news. Analysts seemed perfectly fine with it. Explain the accounting mechanics to me. Why was the market completely okay with that level of short-term financial pain?
To understand the market's calm reaction, we have to explain the fundamental difference between GAAP and non-GAAP financial measures, which Lowe's clearly and transparently outlines in their disclosures.
Okay, GAAP stands for Generally Accepted Accounting Principles. That's the strict standardized rule book that the SEC forces every public company to use so that everyone is speaking the same financial language.
Exactly. Under the strict rules of GAAP, a company has to account for all the messy, one-time anomalous costs associated with doing business, like the massive legal fees of acquiring a company, or that $96 million amortization charge for intangible assets.
So GAAP shows you the raw, unfiltered, total outflow of cash.
Yes. But analysts and institutional investors don't just want to see the anomalies. They want to understand the underlying operational health of the core day-to-day business. That is where non-GAAP measures come in.
Okay, what does non-GAAP do?
Non-GAAP deliberately strips out the one-time acquisition noise to show how the actual retail machine is performing.
Let me try an analogy to make sure I grasp this. Think of GAAP accounting as the brutal, unvarnished truth of your personal bank account today. It includes your mortgage, your groceries, and that massive, unexpected $10,000 bill you just paid to put a new roof on your house.
Yes.
If someone looks at your GAAP numbers this month, you look completely broke. But non-GAAP is like looking at your regular, recurring monthly budget. It says, look, if we ignore the roof, which is a one-time event that will last 30 years, your salary easily covers your groceries and mortgage, and your day-to-day spending habits are actually quite healthy and profitable.
That is a highly accurate way to visualize it. Wall Street is looking at the non-GAAP numbers to see how fast the runner is moving without counting the 30 seconds they had to stop and tie their shoe. When you apply that logic and strip out that one-time $96 million acquisition charge, Lowe's adjusted operating margin, the non-GAAP measure, was a very robust 11.5%.
Ah, okay.
And their adjusted diluted earnings per share was that $3.03 figure we highlighted at the very beginning of our deep dive, which is actually an increase from $2.92 in the exact same quarter the previous year.
So when you remove the noise of buying FBM and ADG, the core Lowe's business is highly disciplined and growing its profitability.
Yes, and we noted earlier that their SG&A leverage actually improved by 17 basis points. They're doing more with less.
Precisely. And they are already beginning to integrate procurement costs across FBM, ADG, and the core Lowe's business. By combining their purchasing power, they can buy drywall, steel, and insulation in even more massive bulk quantities, finding deep cost synergies.
Exactly. They're willingly absorbing the short-term margin hit today to build an unassailable leadership position for when the residential construction market inevitably thaws out and begins building those 12 million needed homes.
So they're playing a very sophisticated, multi-year-long game. But let's bring it back to the immediate short game. We have spent the last hour talking about their triumphs. We've explored the agentic AI tripling conversions, the pro-strategy manufacturing labor, the bold $250 billion market acquisitions.
We have covered a lot of ground.
But no business is invincible. What is keeping Brandon Sink, their chief financial officer, awake at night right now? Because we have to objectively examine the risks, the macro headwinds, and what they see coming down the pipeline in Q2.
The primary immediate concern highlighted by management on the call is persistent inflation, specifically the kind driven by fluctuating global oil prices.
Oil prices.
Yes, Brandon Sink noted a pretty immediate impact whenever oil prices spike. Obviously, higher oil prices immediately pressure their massive transportation and freight network, but it goes much deeper than the cost of diesel fuel.
Oh.
They highlighted the impact on commodity-based products that rely heavily on petroleum derivatives, specifically resins and plastics.
Right. If you think about it, half of a hardware store is made of plastic. PVC pipes, tool casings, storage bins. If the raw cost of the plastic bucket goes up because oil went up, that immediately eats into the profit margin of the paint sitting inside that bucket.
Exactly. The margin compression is insidious. And on top of that, they noted near-term pressure on their operating margins from those higher transportation costs and from concentrated sales-driving investments.
Sales driving investments, meaning they are having to spend more money on aggressive marketing campaigns, localized promotions, and discounts just to fight for every single customer in a market where foot traffic is heavily constrained.
That's the reality of it.
Plus, operating a global supply chain means there is always the looming specter of unpredictable tariffs and geopolitical chaos disrupting the flow of goods. So how on earth do they defend their profit margins against all of those external forces? If oil goes to $90 a barrel, do they just raise the price of a hammer and pass the pain onto the consumer?
Raising prices on a stressed consumer is the absolute last resort, as it destroys demand. Their primary defense mechanism against inflation is an internal operational engine they refer to as PPI, or Perpetual Productivity Improvement.
Perpetual productivity improvement. It sounds like corporate jargon. How does it actually function mechanically?
PPI is a relentless, ongoing series of granular initiatives designed to drive microscopic operational efficiencies and cost reductions across every single facet of the business.
Give me an example.
The thesis is simple. If macro forces push your external costs up, you must find internal savings to offset them. For example, if oil prices push shipping costs up, they utilize a PPI initiative called Freight Flow 3.0.
How does Freight Flow 3.0 save money on a loading dock?
It optimizes the exact sequence and physical labor required to unload a truck and restock a store shelf. By analyzing the physical movements of their associates and redesigning how pallets are packed at the distribution center, they can reduce the hours needed to unload a truck by 10%.
10% just by optimizing movements.
Yes. They use these internal efficiency gains to absorb the inflation, protecting their margin without having to raise the retail price of the hammer.
It's like drafting behind a semi-truck on the highway. You can't control the price of the gas in your tank, but by changing your aerodynamics and driving perfectly in the slipstream, you burn less gas to go the exact same speed.
That is exactly what their PPI engine is doing.
But while they are battling inflation internally, they also discussed a very interesting macroeconomic dynamic regarding the consumer's wallet, and it revolves around the IRS. Apparently, the expected government stimulus via tax refunds hasn't fully materialized in the market yet.
Yes, their internal data analytics team did a deep dive on this specific issue.
Because of various delays and changes in filing patterns this year, they estimate that only about 20% of the tax refunds issued so far have actually been spent in the retail economy.
Only 20%. Where's the rest of it? They estimate that approximately 50% of that refunded money is currently sitting stagnant in consumer savings accounts, likely acting as a psychological buffer against broader economic uncertainty.
And the rest.
The remainder largely went to offsetting higher essential living costs, like groceries and fuel. Furthermore, their models indicate there is still nearly $50 billion in tax refunds yet to be distributed over the next few months, largely tied to complex tax extensions.
So there is a massive $50 billion pot of consumer cash just waiting in the wings.
Correct. And Lowe's explicitly stated that they expect this delayed money to eventually unlock and flow into the economy during the second quarter, specifically acting as a catalyst for discretionary spending among higher-income consumers, the upper arm of that K-shaped economy we discussed.
But even with that potential tax refund tailwind, when they take all these complex variables into account, the volatile oil prices, the persistent lock-in effect freezing the housing market, the delayed consumer spending, they still have to give Wall Street a firm forecast for the rest of the year.
They do.
For Q2, they guided that they expect their adjusted earnings per share to be about 2% below the prior year, and they expect their comparable sales to be near the midpoint of their full-year guidance, which is a range of flat to up 2%.
Right.
However, despite a slightly soft Q2, they affirmed their massive full-year guidance, projecting $92 billion to $94 billion in total sales. Let's synthesize this. Is a forecast of flat to 2% growth a giant red flag that their engine is finally stalling out? Or is it a quiet victory lap given the brutal realities of the 2026 economy?
This is where we have to apply critical thinking and evaluate Lowe's performance relative to the broader environment, rather than in a vacuum. We established definitively at the beginning of our analysis that the broader home improvement market is essentially flat, and the housing turnover market is effectively frozen solid.
Solid ice, yeah.
In that stagnant environment, Merely maintaining positive comparable sale, even if it is just 0.6% or 2%, is not just treading water. It means they are fundamentally stealing market share directly from their competitors.
Because the pie isn't growing.
Exactly. Every single dollar Lowe's adds to their top line is a dollar that a competitor lost.
So flat growth in a shrinking market is actually aggressive expansion.
Exactly. They have refined their digital tools, acquired commercial distributors, and streamlined their internal operations so efficiently that they are completely decoupled from the housing market's drag.
Decoupled entirely.
As the CEO stated, their current positioning means they are primed for meaningful upside as macro conditions normalize. When the economic winds finally shift, interest rates drop, and the housing market inevitably thaws out, Lowe's already has their sales fully deployed and optimized to capture the momentum.
All right, let's pull all these threads together because the sheer density of strategy we've unpacked today is remarkable.
It's been a lot.
We started by looking at a legacy retailer trying to survive a frozen housing market where homeowners are terrified to give up their 3% mortgages. But what we found under the hood was something entirely different.
Lowe's isn't just surviving, they're evolving.
They are utilizing autonomous, agentic AI to literally triple their online conversion rates. They are launching a software-style subscription model to dispatch Red Vest associates to maintain DIR's homes.
And they are pouring $250 million into creating their own future pipeline of pro customers by training the next generation of tradespeople.
And, perhaps most aggressively, they just bought their way into a $250 billion commercial and new home construction market, all while using internal operational efficiencies to drive down their overhead costs in the face of inflation.
They are completely redefining the boundaries of what a home improvement retailer is structurally capable of. And, analyzing their strategy leaves me with a final, provocative thought to ponder, connecting a few of the seemingly disparate technological capabilities we discussed today.
Oh, I like where this is going. What's the thought?
Well, we know their AI can instantly parse a contractor's messy handwriting, calculate complex loads, and automatically order materials. We also know that Lowe's is now actively selling a Home Care Plus subscription, where a trained associate physically comes to your house to perform routine maintenance and diagnose issues.
I see the pieces on the board.
How long until those two technological capabilities seamlessly merge? Imagine a near future where your home has a complete digital twin, a virtual model of your house's systems monitored 24/7 by Lowe's agentic AI.
A digital twin.
Wow. The system, utilizing IoT sensors, predicts exactly when your HVAC compressor is going to fail based on minute vibration data. The AI autonomously parses the specific parts needed, pre-orders them from the local Lowe's distribution center using freight flow logistics, and automatically schedules your Home Care Plus associate to come to your house and install the new compressor before you even realize the old one was broken.
That is mind-blowing.
This raises a profound question. As AI and physical logistics integrate, are we witnessing the final days of traditional home improvement and the dawn of fully automated home management?
Wow. From driving to the store to buy a hammer, to living in a house that preemptively fixes itself using a corporate AI, that is a wild but entirely plausible trajectory.
It really is.
Thank you for joining us on this incredibly deep dive. Whether you are currently building a raised garden bed, analyzing the macroeconomics of retail stocks, or just wondering why your local hardware store is suddenly selling premium dog food, keep asking the hard questions, keep looking for the underlying mechanisms, and always look under the hood. We'll catch you on the next deep dive.